Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is December 17th. A lot of little news items on the go. Nothing too substantial, but I think some things that are going on are going to be a telltale sign of the future of the housing market, at least for the next little while. So, by the way, if you'd like some information on the top 50 housing markets that are most exposed to a bubble, go to housingbubble2.com, download my free report. I've also included a section in there on why short sales are fabulous and why you should be doing them. Simple as that. And regarding real estate training, I know a lot of people inquired. If you'd like more information, please direct message me via my email. You'll see the email pop along the screen here shortly, and you'll also see it in the information on the About Us page, and et cetera, et cetera. So also, I'm offering really great discounts right now for the holiday season. I'm looking for about 3 people to join, which will sort of complete my goals for the year. So I've got some pretty significant discounts. And what do you get with my advanced short sale training? Pretty much is online education. You get access to group mentoring, one-on-one mentoring, deal flow analysis, deal partnering with me, access to my network of a lot of things that I have and that are beneficial, and also access to my negotiation team as well too. So I can show you how to do this and get you going on the short sale world. So if you're interested in doing that, again, I got discounts. I'm looking for a handful of people to join, and we'll be good for the end of the year. Starting in 2020, which I do believe will be the year of the short sale, based on where I see everything going. This will be a more of a formal launch for my product, and we'll go up to retail pricing. So giving people the opportunity to jump in now, and prices will go up and things will change once it goes a little more broader in scope. So just giving you some heads up. If you want to jump in, inquire, let me know. All right. Also, I'm getting a lot of increased opportunities for fix and flip properties. Sorry, a little tongue twister there. Fix and flip properties in my area. If you're interested, please inquire via email, give me your contact information. And I'm talking about serious inquiries, so I'm not talking about you putting it under contract and looking for an end buyer. It's more of that you have the capacity and wherewithal to actually close on it, do the fix and flip. I can guide you along the process. But again, these are things that are primarily in my area. I'm getting more and more of these coming across my plate every day, and there's some cool stuff there if you're interested in fixing and flipping. All right. Also, if you're not already a subscriber, please click the little button on the bottom right of the video and click subscribe. I appreciate that. It helps my channel grow. So here's the scoop. First item of news today is flipping starting to flop. And the reason why I say that is Adam Data Solutions, of course, released their third quarter 2019 U.S. home flipping report. And it showed that about 56,500 homes were, I guess you say single family homes and condos were flipped in the third quarter of this year, which is down about 13% from the previous quarter, down about 6.8% from the year before. So what is this telling us? It's telling us the fact that less is going on. There's less flipping going on because there's less homes out there. Inventory is tight, which we all know. And I guess their comment was after an unusually, we'll call it lively flipping market in the spring of this year, this decline stood out as the largest quarterly decline of annual drops since the third quarter of 2014. So it's notable with respect to what's been going on in the past really 5 years. And the homes that were flipped in the third quarter represented 5.4% of all home sales in the quarter, which is interesting. So you can see it does impact the economy and the marketplace for sure. Trends in the flipping market are telling, and the gross profit generated on a flip for the third quarter of 2019 was $64,900. This was up from 1.8% from the previous quarter and 3.5% from a year ago. So the actual, we'll call it gross flip profit, went up. However, this translated into a 40.6% return on investment compared to the original acquisition price. And things like that. So, and now the actual, we'll call it return on investment's been shrinking. That's why I'm saying it's flipping, flopping. And the reason being there's less homes being flipped. We see declines in that. Also, there's been a trend that, we'll call it the margin is 40.6%, which is down from 41.1%. The previous quarter, which is down from 43.5% the year before. So we are seeing the fact that it's going smaller and smaller and smaller with respect to what you're getting with respect to flipping margins, and this is the second lowest point since 2011, which is it's just barely above the 40% return on investment. Now, again, we're going back to I don't know how they're going to calculate return on investment. I'm assuming it's basically purchase price, what you put into it, what you made on it, etc. So that's the scoop on that. What people are saying though, declining profits on flips are leading to much greater interest on fixing and renting. So if you're not making the big money on your fix and flip, what you might want to do is acquire the property, fix it as a rental, and now you're able to, you acquired an asset, the asset could possibly appreciate and you're getting some cash flow. And also with respect to fixing and renting, fix and flip, you're buying a property to be sold on the retail marketplace, which means you're going to deck it out. It's got to compete with what's out there. So you have to put time and effort, and it's got to be nice and show nice and have it has to have all the, we'll call appointments that a normal, almost like a new house would have if you're a buyer going to pay premium or market price for the property. If you're looking at fixing and renting, you don't probably have to put in as much money into the property because it's for the rental market. So you don't have to put in high-end appliances and quartz and glass and things like that. You can go with certain type of countertops, lower grade granite, basic appliances, things like that. So there certainly is a method to make things work on both ends, but the trend now is if it's too expensive or it's costing too much money and the returns are down, let's find a new way of maybe making this pay, which is interesting. Now, home flipping rates are down in 78% of the local markets. I attribute that to, again, pricing points and lack of inventory. That's quite obvious. More information here. The biggest decreases in MSAs, or metropolitan service areas, with a population of 1 million or more were in Rochester, Grand Rapids, Michigan, Boston, Providence, Rhode Island, Milwaukee, Wisconsin. So these guys are having between 29 and 24% decreases in flipping activity. So obviously, there's less going on in those markets. If I go a little bit deeper here, the average time to flip nationwide is 177 days, which is down from 184 days. So again, flipping tends to be from start, which is acquisition, to doing your work, and then when you actually sell it to the end user, whoever that's going to be, it's always around 6 months time frame. Okay, so it's usually like it was 184 days before, now it's 177. So really, it's always hovering in that 6 month time frame to do a project on average. So there's people who can do it quicker, typically better or more skilled investors, or people who will take longer, which typically is newer investors, those that run into problems, things like that. So keep that in mind. And excuse me, there's locations that have, so the smallest gross flipping profits are Raleigh, North Carolina, Austin, Texas, Phoenix, Las Vegas, and Kansas City. Now things like Raleigh, Phoenix, Las Vegas, and Austin, I can see, again, very competitive there. Prices are expensive there, so your money's not going to go as far, and it looks like you're making less money to flip in those marketplaces. And let's take a look here. For flipped homes sold to FHA buyers, so the flipped home, the finished product that was sold to an FHA buyer increases from the previous quarter. So 14.5% of properties sold by flippers were buyers using a loan backed by the Federal Housing Administration, FHA. So that could be Fannie, Freddie, VA, whatever. So realize that that's increasing, again, based on the fact that, it's tough to find properties. And my also comment is that if you have lower down payments and if some of these government-backed loans are easier for people to get into, then more of those finance people are going to be using FHA. It just seems to be, so everything seems to line up with what's going on in the marketplace. So that's kind of the scoop on that. I'll put there's top 10 U.S. metros with the highest percentage of all cash purchases flipped in Q3 2019. I'll put that in the community section so you can see that graph here. But I look at this going, is this a telltale sign of what's coming? Before the last housing crisis, there were certain things that were apparent. So flipping had kind of reached its peak. Flipping was going on and profits were decreasing, which means people were either getting, prices were too high, people were getting tapped out, and that's just started, that was one of the precursors to what happened afterwards. So whether this is another sign, I'll let you be the decision maker on that. But to me, this is one more thing that just sort of proves the fact that we are at its peak, the bubble's bubbling, and things are changing in real estate investment world. So there you go. Something else that is interesting is refinance boom pushes weekly mortgage applications higher. So this is interesting. So refinance volume drove Total mortgage application activity 3.8% higher last week, according to the Mortgage Bankers Association. Applications to refinance a home loan jumped 9% for the week compared to the previous week, and were 146% higher than a year ago. So with lower rates, what are we seeing now? Is we're seeing a lot of refis. So there's just always information about how that's working out through here. And the reason why I think this is important, because we can still see this as a trend. So if rates are lower, people are dipping into that refinance market. So when you refinance, you're getting rate and term, or you're pulling cash out. That's up to you, and that depends on your property. But here's this article sort of coincides with that. It says refinancing surges as homeowners pull out the most cash in 12 years. So for me, this is yet one more sign of what's going to happen in the future, because people are pulling cash out. So refinance lending has nearly doubled over the past 3 quarters, according to Black Knight Financial. Cash out refis were up 24% since the last quarter of 2018 and made up 52% of all refinances. So people are doing rate and term, but cash out. So you're pulling money or you're equity stripping out of your home. That's again, more than 52% of all refinances, people are taking cash out, which means that they're equity stripping, which means they're risky as opposed to what's left in their property. If the market values change, they're more exposed. And the refinance typically concept is, hey, I'm going to take money out, maybe improve my property so my property is worth more in the end. A lot of people don't end up doing that. We know what goes on there. People use it for buying things, paying bills, going on vacations, buying cars, buying fun stuff. That's what happened the last housing crisis. So we're seeing this trend again, and I always look at it going, what do people do when property values are at the peak? Well, if we see all these signs happening, to me that's what happened last time through. So I'd look at it going, history repeats itself. Why I think things are going to crumble this next year is because we're seeing everything that we saw 10 plus years ago, and it's happening again. And no one is controlling it, and no one seems to care, which is the fun part. So homeowners withdrew a collective $36 billion in home equity, the highest amount in nearly 12 years. So now this amount is a lot. It doesn't compare quite to what happened in 2005 and 6, where people were pulling out money like you wouldn't believe. Those are massive. But again, highest amount in nearly 12 years. So since the last housing crisis, where people were pulling out cash at refis like you wouldn't believe, we've just sort of hit a new high water mark since that point in time. So to me, this is, as I said, one more thing that just sort of makes me go, okay, exposure, risk. People will be stuck in their properties. If they have to move, what's going to happen? Well, they're not going to be able to move unless they can bring money to the table. Granted, people will comment and say, well, we have tighter guidelines and this and that. Well, tighter guidelines mean nothing when property values decrease and you owe more than what your home is worth. That's how that kind of plays out. So, don't think this is anything special with respect to our qualified mortgages these days. So that's the scoop on that. So to me, this is an alarming sign, and which ties into this next article, which says mortgage credit availability rose in 2019. So according to the Federal Reserve Bank of New York, mortgage credit availability rose this year and will stay that way in 2020. Rejection rates for credit cards and mortgages fell in comparison to 2018. So everything declined compared to 2018 for credit cards, mortgages, mortgage refinance applications, all declined compared to 2018. And looking ahead, households generally expected to be more likely to apply for and receive credit over the next coming year. So it's almost like, hey, I'm going to apply. I think I'm going to get it. Shouldn't be a problem. We're going to just keep working on our credit facility here. The number of home loan applications increased in 2019, driven by respondents with a credit score of more than 680. So we're seeing some better credit numbers coming through for people who are actually applying. But again, for me, it still boils down to that, they look at this. Low mortgage rates will push home lending this year to a 12-year high, a total of $2.07 trillion, which was forecast by the Mortgage Bankers Association. So, as I said, people are pulling out refis, and we have proof here that credit is easier to get these days. Interesting, another comment here. What do subprime mortgages and student loans have in common? Well, experts say that American student loan woes resemble the subprime mortgage crisis. So that's interesting because American students and graduates are surely debt burdened. We all know that. And when we start looking at this information, what I find is interesting is that according to Realtor.com, millennials who make up 34% of all student borrowers hold about $500 billion in student debt. have an average student loan balance of $33,000 per borrower, which is $7,000 more than the typical down payment for a median priced home. So there you go. So there, this again, back to the whole what's holding back buyers. Well, we know it's also lack of inventory. We know that high prices, but also it's called getting qualified for a loan. And not everybody wants to put down or only put down 3%. People want to put a little bit more down, and that's going to help them, in the end, financing their property, having more equity. So it's just difficult to do so. So there was a online real estate survey took place, and 84% of millennials believe homeownership is part of the American dream, but a whopping 48% of undergraduates are putting off buying a home because of their student loans, so we understand that. And a study from Apartment List indicates that half of millennial renters had no down payment savings in 2019, while at least 12%, an increase of 2% from last year, had no plans to purchase a home. So there you go. So people nowadays don't have the money. They're not saving money. And a lot of people are sort of going, well, based on where income is and wages being more stagnant, not keeping up with home prices and other things, that they have these debt burdens. They don't think that they're going to even be able to ever buy a home. So that home sentiment is changing with respect to consumers, which is not the best thing in the world. And according to some of the experts out there, the student loan world is now seeing default levels that are similar to subprime mortgage world of about a decade ago. These defaults have negatively impacted borrowers' credit scores, thereby it impacts their ability to qualify for a mortgage. So if you're defaulting on your student loans and you want to buy a house, it's gonna be a negative line item on your credit report. It's also going to help deliver lower scores, which means when you qualify for a mortgage, it'll be tougher to qualify with respect to rate and down payment and things like that. So it's interesting how this all kind of works together and spins around. But how does this work? It's making it difficult for the next generation to actually jump into a home, which is kind of sad. This is interesting. This is the last article for today. U.S. home builder sentiment soars to 20-year highs, which is interesting. It's home builder sentiment, so the actual builders themselves. But there's just two problems. And I really kind of find this interesting. It's kind of like, maybe we got to talk ourselves through the situation so we can believe what we want to believe here. New home sales are still 47% below their peak in 2005. And the buying climate for homes, based on a survey which is done by the University of Michigan and the Home Buyer Survey, Sentiment Survey, has collapsed to its weakest since 2008, despite lower interest rates. So there's that tagline again. So all these things that are happening in the real estate world that aren't looking good are in spite of having great low rates here. So obviously certain things are preventing buyers from jumping into the marketplace. Well, December reading caps a 20-point gain for the index, which is great. So the home builders are going, hey, we think the world's great out there, but funny enough, the consumers don't quite add up to that. And I guess what we're seeing here is some quotes from the chief economist for the National Association of Home Builder. Says that while we are seeing near-term positive market conditions with 50-year low for the unemployment rate and increased wage growth, we are still underbuilding due to a supply-side constraint like labor and land availability. So yes, it's tougher to find skilled labor, tougher to find cheaper price land. So higher development costs are hurting affordability, which we know. The traffic of prospective buyer components was dominated by a surge in the Midwest. And while will new home sales, construction, and buying climate ever catch up to the optimism of those who make their livings based on this magical thinking? Who knows? But the stocks aren't buying it either. So that's the funny thing. When you look at their chart here, it shows that home buyers, builder sentiment is up, but builder stock prices are not up. So there's a big divergence there, and that coincides with home buyer sentiment. So I don't understand how home builder sentiment can be so strong. I guess they figure if they build it, they will come because you've got nothing else you can buy. That could be the reason before that, or why their sentiment is so strong. Who knows? I just find it interesting that builders are thinking the world's great when not every home buyer thinks that way out there. So anyway, interesting stuff here. So thanks again. I just want to end off here with, again, thank you for the views, the comments, likes. I do appreciate that. Remember to inquire with me regarding my advanced short sale training program. I'm looking for a few people to join, and then we'll be set for the end of the year here. It's cool. It's designed to help you get into the marketplace and get deals, which is what I'm doing. On a second note, a lot of fix and flip opportunities are coming my way these days. And again, is it that time of the year? Certainly there are, towards the end of the year, people want to close out or are motivated to move property. So we're working on a bunch of deals now. So if there's interest there, please drop me a line. The next video will focus on foreclosures because a lot of new data came out on that, which is I find very interesting. We'll share that in a couple days. So having said that, have a good rest of the week. We'll look forward to speaking with you before week's end, and talk to you soon.